Good evening, traders. Adam here from Bold Logic, doing a question of the week with you on options and pricing a big move. So, a lot of times in my option post, I will tell you, yeah, so and so is pricing in this big of a move, and so is pricing in this big of a move for earnings, or this announcement is coming up, and the market expects it to move, 20% or 10%. Well, I get a lot of questions on how exactly I figured that out. So I'm going to run through that real quick for you right now. And I want to also pull up an example of a trade I talked about with someone last week on VRNG. VRNG, if you don't know, is in a legal dispute or was in a legal dispute with Google. Something about patents, everybody's suing everybody on patents. And so they had a court decision coming up. Now I figured Google would shell out some money just to keep them quiet. I'm actually not too sure how it ended up. I read the news or anything how it ended up, but it does look like it has ended up. So I was talking with somebody. He was like, "Oh, what do you expect to happen?" So I pulled up the November options because that's when it's supposed to come with two, and we're going to set this back because this is our Think Back tab in TD Ameritrade or Thinkorswim. It allows us to go back in time and look at prices. We're going to go back in the 26th, that is the Friday, last Friday before the announcement came out, which I believe was on Wednesday. So last Friday, I was talking about the move that was expected to happen, and as you can see, the stock is trading at $4, so we're going to look at a $4 straddle. And we do that, we just go buy, and we're going to look at a straddle, right? A straddle is where you buy the call and the put at that strike. Now, this allows you to play both directions, up or down. It does not matter. What you're just expecting here is a really big move. Now, this is a good way to see exactly what the market thinks. Let's pull up. Let's just do it real quick. We're going to jump into real time by straddle. So this is what a straddle looks like. Basically, you have your option here. This is your strike down here, and you have the call and you have the put. So it allows you to profit if the market goes up, or if the underlying goes up, and allows you to profit if it goes down. As you can see, it just takes a really big move to actually make that jump. But if you get that big move or a nice boost in volatility, you can actually profit from a straddle. But it is good to use straddles to price a move because it doesn't mean you have to know which direction it's going to go. It just tells you how much people expect the underlying to move. So as you can see, on a $4 stock, remember it's trading exactly at $4, which I love because it makes this really easy. People expected a $2.32 move. Now just put that into perspective, we got a 2.32 move divided by $4. That is a 58% move. They expected this stock to move 58%. Now that is a big move. That's how we tell how far the market plans on the stock moving. Now this works for FDA announcements, something that everybody knows is going to happen. They can see what the market is thinking. Earnings. If you ever look at your favorite earning companies right before they have earnings, pull up the options, pull up the nearest term options. For this one, it's November. It's 21 days out. That was the nearest one. Pull it up. Look at the money. That means right where the stock is trading. So our stock is trading at $4. So we go down to the strike at $4. We just find the closest strike there is. Sometimes we have to get a little bit close. Sometimes we're off like 10 cents or so, but we just take the closest one and we look at it, and that tells us what the market is expecting. So we look at the straddle price, and that tells us what the market is expecting. Now, what most people believe is that the market overshoots, or it gives too much leeway to these people earnings announcements. So what happens is a lot of people like to sell straddles or sell strangles. Basically, that is the same play we just looked at. This one, but you're going to flip it upside down. You see, so what you want to do is have the stock stay in between instead of having a big move. You expect it to stay in between there. This is a good play if you're expecting volatility to come out, which happens a lot of times in earnings plays, or if you expect the stock not to move. The bad part is the market is really good at figuring out what the straddle price should be. So usually when you sell these things, you're actually going to lose over the long term more than if you were to actually buy these. So selling straddles or strangles and the earnings and big announcements is usually not a good idea. You're going to lose in the long term. It's better just to buy the straddle or the strangle and just hope you get a big move. In the long term, you'll actually probably make money. So let's look. Now we had our $2.32 move. That's a 58% move of this stock. So let's see what happens. So we're going to go to our charts. This is VRNG. I already got it pulled up. Can you guess which day is Wednesday? Yeah, and it's going to be this big candle right here. I know everything's in black and white. Just deal with it. There's going to be this big candle. So it did gap up a little bit, even though it started at $4 the previous day. It did gap up a little bit. Let's see what that move is going to be. It went all the way down to, let's see, I forget where my lows are. Ah, look, $1.75. So we started at $4, and we go to $1.75, and we divide it by 4. That is a 56% move. So this is why the market is really good. I mean, this shows you that how good the market is at pricing these moves. I wouldn't have thought this was going to move 58% that day, but obviously a lot of people did, and it did move 56%, which means if you would have sold those straddles or strangles, you would have probably ended up at a nice loss. If you would have bought those straddles or strangles, you probably would have ended up with a nice gain. So this is how you figure out the movement of something like an underlying that's going to have an earnings announcement or an FDA announcement or some big piece of news that everyone's expecting. This is how you figure out what is going to move. This also shows you that how right the market is. 58% move, and it actually moved 56. That's pretty close if you ask me. It went all the way down to $1.75 before it bounced all the way up and finished at $2.60. So here's just a quick lesson on using options to find information about the market. Even if you don't trade options, they're still very useful to find out that extra information. All right, everyone. Hope this helps you getting ready for earnings season because we're in the middle of it now. So use this trick to figure out what people are thinking, and then you can see how it's going to react and how the earnings are going to affect the options. All right, everyone.